Thank you, Ravi. It's good to be here and to be part of this discussion series. I'm going to try and make this a little bit personal, so not just talking about, and if I can figure out how to advance this. Oh. Right. Yeah, that's a, very strategic. Perfect. Great. So I thought I'll start with something a little personal and probably unusual in terms of background and speaking about a little bit about what I've done. And it's interesting that I've been able to summarize my life into one slide, scary in a way. But just to give a context of, a little bit of where I'm coming from. So born and grew up in Lagos, Nigeria. Parents met in college in the US, Wisconsin, actually. And then mothers from Lancaster, Pennsylvania, fathers from Nigeria, met 21 years old, moved to Nigeria. Parents were university professors. So instilled in me importance of lifelong learning, very critical. It's hard to not have that when you have parents who are professors. That's actually the picture of the house I grew up in. Not taken when I was a kid, but taken more recently. I actually took my kids back just to show them a little bit of history. Private school, for the most part, in different parts of Nigeria than the US. And started out my career very traditional. Graduated, went into finance, worked in Dallas, worked on Wall Street, and wasn't as fulfilled. Learned quite a bit with great colleagues, but wasn't as fulfilled. Decided to move back to Nigeria, where I felt I could have some impact, and worked for a number of years in different industries, oil and gas, financial services, telecoms, and was really moved to see how do I support entrepreneurs to build businesses. At the time, was sector agnostic, but in about 13 years ago, saw an opportunity in the agribusiness sector. Was shocked about the amount of food that was imported into the continent. A lot of it I felt could be grown locally and businesses could process, package, and then sell. And then decided to move into that space. So very unusual pathway from private equity to doing this, but decided to move that space. Knew very little. So the first thing my wife and I did at the time, because we were working together when we decided to do this, is to set up a food processing company. So we got a rented location outskirts of Lagos, Nigeria, built a company from scratch. And that company has grown today roughly 140 employees, exports, B2B sales, spice, seasonings, packaged food, works about 10,000 farmers. But what it really showed us was what it takes to build a business in an environment like Nigeria. So I started doing consulting work in 2011. Small projects became bigger projects. And right now that firm, Sahel Consulting, has roughly 60 employees out of an office in Nigeria doing regional work. Works with many international clients, supply chain analysis, management consulting, policy implementation. And then in 2013, decided to set up Sahel Capital, the investment arm. The Nigerian government and the German government wanted to bring a new type of capital to the sector. And we were selected to manage those funds and then went out to fundraise and then raise additional capital. But had a journey, effectively traditional, then non-traditional at some point. In terms of what I do day to day, effectively we look to back entrepreneurs in the agribusiness sector. We have footprint across sub-Saharan Africa, started out in Nigeria, and then now do debt financings in 13 countries, equity in a handful in West Africa. That's now part of the team, and some images of some of the deals we've done. Now, in terms of how we engage, it's more than just providing capital in many cases. It's many of the entrepreneurs actually need technical support as they build their businesses. So a big chunk of what we do is see how we can wrap around that technical support. We have individuals that have built and run companies before. And so it's very helpful to have those individuals alongside as we engage with the entrepreneurs. Now, why do we do what we do? Is effectively, we're looking to create and build and scale businesses. Now, these are pictures of real entrepreneurs. Some of them we've worked with. And I'll pick in different sectors, but I'll pick one individual just to give you a sense, and that is Dr. Cosmos Maduka, who is on the cover of Forbes Africa. And he, very humble background, only did primary school, only grade school, and lost parents at a very young age. So worked in informal markets doing car spare parts, and effectively was very good about surrounding himself with good people, continuous learning, and effectively built a $500 million conglomerate today across different sectors, which is not easy to do. But it just points out the importance of tenacity, grit, and lifelong learning. It doesn't matter where you start and come from, but if you can build up pretty significant conglomerates. He has a subsidiary, decided to venture into farming, commercial rice farming. We partnered with him, I think, in his year 3, year 4, and I've worked with him to scale the commercial rice farming operations, and which I'll touch on in the case study a little bit later. And quite frankly, he didn't need our capital, but the pitch to him was we could bring technical support to support him as he scaled. And different entrepreneurs doing different amazing things across the continent. And if you think about businesses in general, there is a plethora of many small SMEs, and very few actually scale to much larger billion-dollar companies. And the key differentiator is really that technical support and wrapping around the team that actually enables people to scale. I think which is what we bring to the table when we engage with many of the entrepreneurs. Now, I'll touch on, before I go into case studies, just to give you an idea of the private equity landscape on the continent. Now, as context, roughly 20 years ago, very limited activity. Most of investments were done out of offices in London and Washington, DC. So if you wanted to do private equity in Africa, you were based in DC, London, flying in, trying to do deals and flying back. And it's very difficult to be effective doing that. But quite frankly, those offices worked because they were close to the providers of the capital. Now, as the years progressed, what we found is that there were more and more locally based private equity firms, which is very critical because to be close to the deals and entrepreneurs, you have to be in the market. So you just have to fly in and move out. And right now, there are probably over 70 fund managers that are specifically focused on doing private equity in Africa. Most have offices on the continent. Very few now have offices outside the continent. This gives an idea of size of industry in terms of capital raised, number of deals. It's a small percent of what happens in the US or Europe, but it's been increasing quite rapidly. West Africa accounts for a big portion of the volumes. If you think of hubs in Africa, West Africa in particular around Nigeria is of activity, East Africa around Kenya, and then Southern Africa has quite a bit of activity as well. In terms of fundraising, gives an idea of trends. Of course, during COVID, there was a dip. These are some of the different fund managers on the continent, just a snapshot. And just to point a few things out, of this 1.6 billion, 800 of that was raised by DPI, and it's probably the largest single fund raised on the continent. And roughly 400 was raised by African Investors. So that was their fund 4, and DPI is their fund 3. So what you find as well, there are 2 different strategies for funds. Some are looking to raise larger, successive, bigger funds, which I think is the model in the US and Europe. Others are looking to have smaller but multi-fund strategies. Okay, I guess I'll ask one question, and then I'll leave questions to the end, but I'll let you go ahead with that.
I just want to have a clarification. When you say private equity,
yes,
does that encompass venture capital? Because private equity, in the United States, I will say, is distinct from venture capital. And it's often, I guess, focused on, maybe taking public firms private. And I just want to be clear, how is it in Africa? What does it entail?
Important question. So I'm using private equity as a general catch-all bucket, which includes venture capital. So a chunk of this fundraise is also venture capital specific. And so there's a whole spectrum of that activity. The difference, though, in activity in the US and in Africa is that there's very little take private activity. It's more growth capital. And there's also very limited use of leverage because debt is expensive on the continent. If your local currency borrowing at 23%, it just becomes more risky to take on leverage to do deals. Also, a big chunk of the capital providers are DFIs, development finance institutions, and they're very hesitant as well about the use of leverage at the fund level. So many of the legal agreements have restrictions. So this activity is a mixture of growth, basically taking companies of $1 million to $40 million revenue and helping them scale. It is, I'm not aware of any take privates, any public. In fact, if anything, is a push to take public, not the other way around. And venture was practically non-existent 5 years ago, but is more active in recent times. And this gives an idea of some of that big breakdown. So in what is interesting is the 4 billion of deals. And if I go to the slide before, you see the totals sort of don't match. There's sort of 4 billion fundraised here, 7 billion deals. And a big reason for that is that there's a lot of offshore venture money coming in to the continent. There are 5, 6 unicorns right now on the continent, early stage firms that raised a ton of money. And so that 4 billion includes if I remember my numbers correctly, a 400 raised Series C of a payment system company, OPay, includes a 250 million raised by another firm. So there's a lot of money coming from VC that is not Africa specific, but looking for deals, in addition to regular locally based fund manager transactions. And venture, of course, it's smaller tickets, quite a bit of volume happening, and it's come from very little to where it is today. Now, I guess the question is, why is it an attractive destination at all? You know, it's easier to allocate capital to, the US, to Europe, even Asia. I should tell you that there are many risks with the emerging and frontier markets that you have to be concerned about. But there are also a huge amount of opportunities. And the question then is, how do you tap into these opportunities in a thoughtful way? So the first is, it's a large and fast-growing market. Lots of consumers, 1.2 billion consumers. Now, income is very low, so GDP per capita is $2,000. But the question then is, for those firms, how do you create products and services that can appropriately priced for the mass market? And if you're able to do that effectively, then you have a little bit of 1 billion people. And how do you then build scale around that? And what you find is that some of the fastest growing companies on the continent are effectively taking market share from multinationals, because they're doing more targeted advertising, product pricing, distribution is key, and they're producing products at the appropriate price point developed in the local markets. Changing demographics, continent of young people, median age is 18. A lot of people moving from rural areas to urban centers, and many different implications. So consumption patterns are changing. People want convenience. They want, local. There's some aspirational. And to give context, in Nigeria, roughly 20 years ago, there was practically no consumption of instant noodles. Today, Nigeria is probably the 10th largest market in the world, with billions and billions of servings, every year, and in a 20-year period. So, and there are a number of different segments that are like this. So if you're an entrepreneur or investor, it's how do you find those businesses that developing products that can target this demographic shift and to this market. Disruptive technologies, it's quite fascinating that, just use 2 examples. The Nigerian banking system is probably more efficient in terms of speed of transaction closure than the US. Just technology, there's some security around that, but you can transfer money almost instantly versus having to do the wire. In Kenya, they were using payment apps long before many different people. And it's, I think the way to think about it is, how do you use technology to leapfrog past infrastructure constraints? And then at the same time, where you then determine where there are constraints, are there particular services or products you can develop to bypass? And I have a case study to give an example on this as well when we go there, just to give an example of some of what the opportunity is. This is a little bit more recent, number 4, supply chains being redrawn. And the way to think about it is that for many years, it was all about, cheaper is better, offshore, bring it in when you need it. And I think we've all realized in recent years that resilience in supply chains is in many cases more critical than cheap. And just to ensure when there are disruptions, that you can ensure that supply of your raw material, even with those disruptions. And for many businesses, it means being close to having supply chains close to local markets. Now, from an investment perspective, it is how do you invest, support, build capacity of companies to backward integrate? How do you look for import substitution strategies where you can figure out where there's a competitive advantage? Because there's going to be a move toward this direction, whether it's backward integration, import substitution, whatever it is, and figuring out how to invest and build capacity there. And in those firms, whether agribusinesses or otherwise, that have very strong rich supply chains will have a competitive advantage moving forward. Agribusiness sector in particular, it's a ton of people across the continent involved in the sector. And this is beyond farmers. This is everything from distribution, retail, processing arm, the whole chain. And 100 billion odd imports and exports, mostly of commodities, but a range of different products. Now, there are constraints on the continent, and I'm not going to touch on what you probably hear in other presentations about macroeconomic risk, political currency, because I think you face that everywhere in the world. Europe, Latin America, we're seeing that in Europe now as well with the pound and euro. So there's always going to be that. But in terms of what is probably unique, and these are softer issues of when looking for opportunities, what you need to think about. And the first is that it's a huge continent. 9 hours flight either direction, east, west, north, south. And what it means is that there is diverse cultures, languages, peoples. You can be based in Nairobi and expect to be effective in Dakar. You can be, it's very different, whether in the French-speaking zone, Portuguese, English, local languages. And then even when you get to particular countries, so using Nigeria as an example, you get to Lagos, and then if you want to get to a smaller town or city, it's another 1 hour domestic flight, and maybe another 1 or 2 hour drive. So if you're going to be close to potential investment opportunities, whether to find them or to monitor after you invest, you need to be as close as possible and have a team that is as diverse as the region you want to cover. Otherwise, you will not be as effective. You see the deals that everybody else has passed over. The second is around talent. And yes, there's competition for talent anywhere you go in the world, but there are particular unique pressures. And by the way, those are real members of my team, just to remind me that I have to make sure that everybody's happy. You have, similar in the US, nobody wants to work in small town USA, or very few people do. That feeling is a bit more intense in many parts of Africa. Everybody wants to be in the capital. So which means if you're building a business or backing a business in a smaller town or city, you have to be very thoughtful and creative about how you bring talent into those companies. And it's not easy to do. And I'll give one specific example for us. We found out that quite a few of our portfolio companies could have stronger finance functions, but there was a timeline to find this talent to this capacity for these companies. And if we waited to find that talent before we did the deal, then we lost time. I mean, it's not what we wanted to do. So we actually brought in an in-house resource, and actually this woman here, and counting background, and we embedded her in 4 of our portfolio companies over 2 years for 6-month stints. Now, the pitch is you're not going to be sent to small town Nigeria and be stuck there forever and have a career at end. But you're going to have exposure to 4 or 5 different sectors, industries. You come back, you be sent back. And so when you then leave after the 2-year rotation cycle, you have depth of experience somebody else would have. And so brought on board a couple individuals like this and then put them through the system. And it allowed us to get talent in quickly and then give time for the company to then find and recruit and bring on their own person, which typically would take 6 to 9 months to find the right person. In an environment where inflation in many countries, not inflation, unemployment is 15 to 25 odd percent, so very high, and youth employment is just through the roof. Most people defer to safety versus risk-taking, which means that if you're a smart young person, you go work for the large multinational. You don't go work for the startup, you don't go work for the entrepreneur that's looking to scale, and which has implications if we as an investor, you're trying to get talent to then come to these smaller firms. And so it's there's soft engagement to build confidence that yes, you're backing firms that have some traction, but at the same time, there's also a premium that you potentially have to pay to lure people over. But there's that pressure, and the environment is not as forgiving. If you with a small firm and it doesn't work out, it's much harder to get back. So that is a constraint. Immigration is another one that is tough, and it's the one that keeps me up at night. Because when you have very smart, well-paid people, everybody wants them. And so we've lost people not to competing firms in the continent, but people moving to Canada because they have an immigration policy that attracts the best. We have people that move to the UK, to the US. And so we have to be very creative. And one way we've done that is to allow remote work. And that has given some flexibility if families are based elsewhere. But it's something that we have to be very thoughtful about because when you have the talent you need and want to execute, it's one thing to watch out from competition, but from other markets, it's quite tough. Case studies, just to give some examples, and I have 4 different case studies, just to give a sense of what transactions would look like. So we invested in this company in 2016, at the time family-owned, commercial poultry operation, fully automated poultry houses, top-line equipment, and we had a large minority stake. And if they said hindsight is 2020, we would have waited another 9 months before we invested. Because soon after we invested, economy went into, there was an economic shock, Nigeria under recession, feed prices went through the roof. So we had a decent performing company that within 9 months just crashed. So business plan went out the window. And so we had to move very quickly to change a number of different things. Actually, before I go there, why did we invest? Huge, relatively, poultry markets, animal protein consumption, very little versus the US, but also very little versus South Africa. So if you think about a growing middle class that is consuming more, if we just move Nigeria's consumption metrics to South Africa's, then that growth would more than double the market given Nigeria's population. And so for us, it's a very attractive dynamics. Nigeria's middle class larger than Ghana's entire population. So for us, it was an attractive sector. Of course, with its own unique risks, but attractive. Now, when the shock happened, we had to completely change business model, shut down the egg business, shut down the feed business, and we shut down the hatchery. And we prioritized processing frozen chicken. Effectively, faster cash-to-cash cycle is effectively what we're trying to do. And we felt we could, and animal feed consumed a lot of capital. We wanted to preserve capital and changed management team, which was tough to do when you have family-owned business. The son is the CEO. And it took 9 months to engage with the family and then jointly hired a external CEO who joined in 2018 and effectively completely transformed the business. So single-handedly drove business growth. And then a few years later, COVID happened, which was interesting. Now, we were panicked because movement restrictions, restaurants shut down, hotels, so your market does dries up. And at the same time, if there's a biosecurity event, you can't just shut your, you have live birds, which you have to feed every day, multiple times a day. So if anything happens, your business was completely exposed. So we worked with the management team, and they did a couple key things. The first was that they decided to source an increasing amount of birds from outgrowers, small farmers. So 2019, very small amount sourced from small farmers and ramped that up dramatically. And what that meant was that there was birds coming in for processing from different geographic locations. So it reduces risk of biosecurity, shutting everything down. We also got volume growth with minimal capex, additional capex. So going through the system. And then for the outgrowers, it gave them access to markets when their route to market was completely destroyed because of COVID. So win for them, win for us. I don't have the numbers here, but effectively, I'll tell you that it went from a $1 million business to an $8 million business in a couple of years. So still small, but rapid growth. But just to give you an idea of some of how we've operated. Now, during this process, we had to clean balance sheets. We had to move to a majority position, which took quite a bit of negotiation to do. And I might touch on that, some of that a little bit later. Costarrics Farms, different context, subsidiary conglomerate. We were quite interested because the volume of rice consumption in Nigeria in particular has increased dramatically over the last 20 years, and 4 times faster than growth rates around the world. And it's middle class consuming more staples and wanting a more convenient type of staples versus traditional food. And so the question for us is, this will be met by imports, or can we produce enough volume domestically to meet this demand? I think we made a bet that yes, it will be imports. Yes, there are tariffs that are some duty protection to protect the local market, but we believe that we can be competitive in the long term. And puts a chunk of money down. And when we backed the company, they only were cultivating 300 hectares. Worked with them to grow that to 1,600 hectares with a rice mill installed in 2019, 36,000 ton per year rice mill and irrigation, so year-round farming, but massive infrastructure, which is hard to see from this image. So we're talking about, and I'm using kilometers, not miles, but 38 kilometers of roads, 8.7 kilometers primary irrigation, a massive flood drain pumps to take water off the farm, so huge amount of infrastructure. So driving around the farm facilities is pretty impressive. And we had to have a creative structure, investment structure, because when you're negotiating with an individual that has bootstrapped to where he's as successful as he has, he watches every dime, and very savvy, very thoughtful. So what we then did with him is effectively did a ratchet structure, which effectively means that based on his ability to achieve business plan, would adjust our shareholding. So that way, if he achieved his business plan, would have different shareholding from if he didn't, to bridge some of the gap in the structure. It hasn't been an easy investment because climate change has had huge impact, and these are floods. In fact, there was a flood 3 weeks ago that's probably the worst in 10 years. And so we have flood prevention plans, but there's still impact from floods. Now, as difficult as this sector is, it's critical from a food security perspective, because with 200 million people in Nigeria, you have to get affordable food, especially staple food, to the masses. Otherwise, there are major implications. Polyfilm packaging, also different contexts, family owned. They produce the packaging material wrap that is used to wrap food and consumer products. Very high capex type business, and some import of raw materials. And in this context, and I'm giving some of the context because even finding the deals, there's opportunities, entrepreneurs, we also have to find the deals, negotiate, execute, close, and then exit. And in this particular case, they were very worried about private equity as a partner. Finding the right partner was very important to them. They had a dip in the year before investors, so needed capital to come in to solve some issues. So the approach they took was they went to a trusted partner to effectively say, who do you believe is a good match for us? And that trusted partner we knew as well. We had a series of meetings, informal sessions where some trust was built before the hard negotiations, and then we invested. And then in this particular case as well, we also agreed to a variable structure that said, effectively, they did what they said they would have certain control position in their company. And they've exceeded business plan every single year since we invested, which has been pretty amazing on what they've done. Now, where we are with them right now is also in the next phase, which is if you think about plastic waste around the world, it's even a bigger issue in many parts of Africa. It is how do they then take some of this waste to process and recycle and put back into products? And can they also do it at a competitive price point versus imported virgin material? I think the answer is yes. So right now, they already take their own waste from the cuttings of their plastic material and put it back into their products. And this next phase will be taking third-party waste to then reprocess and go back in. Trade Depot, we invested in 2021, and it's also a very unusual investment for us because it's more VC than private equity. And the way we thought about deals is it's important to know the companies that are there today doing quite well, good cash flow, but what are the companies coming down the pipeline in the system? So, and especially in the agriculture sector. So we've monitored and stayed close to a range of different companies, and none of them, and the way we've tested is to say, can we use your product or your service in our existing companies? And the answer is no, we don't really see the value added. Answer is yes, we pull in. And we've actually not seen any company that value add before this. And we first met them in 2017, very early stage, so they were too early stage, they were pitching us. And then in 2021, early parts, I was having a conversation with somebody at a large multinational, and they told me the volume of business that they were doing through this company. And within weeks, I was now the one pitching to them that it made sense for us to invest versus, which was a change of dynamic from before. But to give context about what they do, right now with crop distribution in many parts of Africa, you have a Nestle or Unilever. They have distributors with different geographic coverage. They give the product to the distributor. And distributors, and that's a misnomer because they really don't distribute. So they're stock in the markets, and then people come and pick from them. And if you're a Nestle or Unilever, you have no visibility to who is pulling your product, how they're pulling it, where, which makes it hard for new product introductions to make decisions. At the same time, if you're an SME, it is very difficult to get product to market because established distributors do not want to carry your product because it's not proven. So which means that as a small business, you have to build your own distribution, which is extremely capital intensive. We had a dairy company, we invested in 2015 that we just exited recently. And we had to build out their entire cold chain supply from northern Nigeria to different parts of Nigeria. It's expensive, it's time consuming, it's not easy. And to the degree that there is a firm that can take on that capacity just makes this a lot of difference. And what they effectively do is, so it's, they're taking volume from distributors. There's some new market growth, but they have some of their own distribution infrastructure. They use some third party. But what they then do is they take product all the way down to the informal market retailer. The informal retailer can then say, I want to order XYZ products. They can batch deliver to that market, so they can order smaller quantities, they can pick and choose, it's delivered to them. But then, very importantly, that data then gives visibility to the FMCG company, okay, who is buying my product, exactly which ones, where, and allows them to be more strategic even about how they do some of their markets, which they didn't have before. Company, relatively young, very savvy entrepreneurs that worked at another firm, GMV roughly $400 million, anchored in Nigeria, but expanding outside Nigeria as well across continents. And there are a couple other firms that are comparable to this company in other markets as well. Now, so the party message. Now, I think for this discussion, I know that there are professors, faculty, they're also students. And what I wanted to bring to bear as well, especially for the students, is how everybody's life journey is different. And the key thing about, and I speak for myself, that spend time in the US, this made a hard decision, which has worked out quite well to go back to the continent and have some impact. But it's very important as you're thinking through next steps is, what is important to you? What do you want to build? and make decisions around that versus necessarily what is safe and comfortable. And you find, at least I like to think that if you follow your passion and what you're doing, and of course in a thoughtful fashion, I think you could have a more meaningful career journey than if you would have otherwise. And of course, I'm speaking as somebody who made that hard decision myself, but I think it's just important as you think through that. And then as you prepare, looking to see how do you wrap around support of advisors, mentors, as you look to make that transition. So I'm going to pause there and to leave time for questions, and happy to answer any questions that there may be.
So we just had a presentation in my class about foreign direct investment in the world, and it seems like Africa is one of the countries that is getting the most, or at least a lot of foreign direct investment. Is the private equity that you are talking about, like your partners in the private equity, are they foreigners or are they mostly from, where are they from?
The capital providers, it's mostly international. It's probably 98% international. And most of it is development finance institutions. So it's British International Investment in the UK, it's KW Development Bank, it's Aqua Development Bank, it's FM with the Parco.
Yeah.
And there's some pension money from the US, but it's very little. And there is domestic capital from pension funds, but it tends to be risk capital. So Nigeria, for example, has roughly 30 billion in pension money, and 90% is development bonds, and less than 1% in alternatives, real estate and private equity. So it's all international.
Yeah, and and it's interesting that it's a lot from the UK as well. Yeah. So my follow-up question is that I just spent 1 year in Europe, and private equity used to have a very bad reputation. Like, you work for private equity, oh, you are evil, you do that. But it seems like, and now it seems like in this generation of family business that they're in the 4th generation, that they need to grow, then private equity comes in and helps them, some of the examples that you put here.
Yeah.
So what, how do you feel about that? Like, what is the reputation of private equity? Because it had a very thin name in the past, but it seems now you're investing in some companies, sustainability and all that.
Yes, so there are 2 parts to that. The first is that, yes, there is fear of private equity, and especially family-owned businesses. Yeah. And I won't even say just private equity, it's when you have a business that's not taking external equity capital before, there's a concern of loss of control. So that is there. But there's also a difference in terms of how investments are done on the continent versus Europe and the US. So there is, because the providers of capital are development finance institutions, ESG is a huge part of what we have to pay attention to. And this is auditable, real issues around community impact, around staff engagement, different stakeholders. We have to do very detailed reports, so this is very key. The other is that in many cases, if not all, you are building and growing businesses, there's job creation, there's a lot of things around that. While in private equity elsewhere, it may not be the case. It could be job cuts to make them more efficient. So it's a very different dynamic. Now, with that said, there's still quite a bit of time spent on engagement with entrepreneurs to build trust. And in many conversations, I always use a marriage analogy. It is, you could have a great company, but not the right partner in private equity firm and vice versa. So it's about, who is the right partner as investor and entrepreneur to ensure that you scale. And but because of that concern, it does take time to build trust. Transactions don't happen in 3, 4, 5 months. They could take years. In fact, one of our quickest transactions, which we did within 9 months of meeting the entrepreneur, probably should not have done. So any transaction that moves quickly, you probably need to stay away from, but it takes time to build trust. Yeah.
I was going to ask, what does the exit look like for you? And how long do your investments typically last within a company?
Sure. We like to say that we would exit in 5 years. The average, though, across the continent, across fund managers, is 7 years. So just to give a sense. And it's the usual. You can look for strategic, financial, with the stock exchange, sell back to founder, and it's a mix. Now, for us, the exit we did earlier this year was a sale back to the family. And the context is we had 25%, company had amazing growth, It was a dairy company. And we engaged an advisor to do a process. We found two strategics that were willing to buy our stake, but they wanted control. We had drag rights, which meant we could drag the family to sell, but we opted not to exercise that and then went back to the family and said, here's roughly what the market value is based on the offers we have. They want majority. We don't think majority makes sense for you. We have a put to sell back to you at this valuation. Let's agree terms. And then we agreed terms with the family and gave them a period of time with the vendor notes to buy back the stake. And we structured that way because it's everything on the content is relationship based. If you don't do right by an entrepreneur, other people would hear in the market, and that impacts the total deal. So you have to make sure that you find the right balance between, and we got the same value we would have with the investor. There's another deal right now with a strategic and its backward integration. There are some transactions between different private equity firms, but not that many. And probably also not that many because our investors are not keen to private equity firms trading assets. Stock exchange listing is an option, but very little activity has happened there. So where we expect most of our exits to be would be a trade sale to a strategic for the most part, and in other cases, sale back to founders. So for the rice business, for example, we have separate from ability to sell to a third party. We structured ability to sell to the founder with guarantees from his current company, and he has the ability to buy a stake should he want to buy it.
Yeah, so how much support or lack of it do you get from the government? So as entrepreneurs, as investors, because one big question that foreign investors are worried about is political stability, and also how much the government is enabling the sector, whether it's entrepreneurship or private equity. So certainly there's macroeconomic risks. Then there's, the government side that can be a help or a hindrance.
Yeah, so that's a hard question to answer because there's both. So now from an approach perspective, any sector or company that is very reliant on government policy or whatever around the government to be successful will shy away from, just because it's hard to predict.
Yeah.
And you can't make a bet on something that you can't predict. With that said, well, I'll pick the agribusiness sector. For quite a few countries across the continent, Nigeria in particular, because the sector is such a big part of the economy, 20-24%, employs a ton of people. They've been very proactive about trying to see how to enable, grow, and protect. It doesn't mean that all the policies have had the right intended results, but they've tried to figure out how to make it happen. In the countries where that's not the case, it's because they still, and I'm thinking of the Francophone countries as an example, it's because there's still a lot of influence from France, and the policies there tend to benefit the multinationals, bring brokers in versus local domestic companies. But specifics, for example, so there is across successive elections and governments in Nigeria, there's been tariffs on certain products. There's a whole slew of initiatives just to protect industry. And the key thing, though, is can you then build competitiveness regardless of those tariffs? There's also subsidized debt in the market for agribusiness. So in Nigeria, if an agribusiness, you can borrow at 9%. Inflation is 18, commercial loans are in the 20s, so it's subsidized money. So it distorts the market. But if you are an agribusiness, it's great, it's perfect to take that money. In all our companies, we do have that capital. It means, though, that we can't come to entrepreneurs looking like debt, because if we come looking at debt, we're just too expensive. So we have to come looking like equity and wraparound services for them to then sort of forget that equity is expensive, just because that debt is there. But that debt has enabled agribusinesses to grow, develop, I think has been generally favorable, but yes, this starts the market a little bit. But I think to your broader question, there have been policies that have distorted the market, there have been policies that have helped, but generally, I would advocate shying away from sectors or companies that are over-reliant just because you can't predict. and that exposure is tricky. Yeah.
We have some people watching online and they have a few questions. One picks up on the government policy issues. Have you had any, can you give examples of any good or not so good issues in handling the government relations where either the change in policies have been favorable or unfavorable? And another question is about how you raise your capital, which I think we touched on earlier. How much is there like a minimum someone has to invest in your fund before they can participate? And do your investors think of themselves as impact investors, social investors, or are they expecting the kinds of returns that any private equity investor might expect?
Sure. So no questions in there. And I should also disclose that the Nigerian government is an investor in one of my funds. So in terms of a positive, and there's some bias there, but in 2013, the Minister of Agriculture at the time, who was the current president of the African Development Bank, felt that we wanted to figure out how do you catalyze more capital to the sector, because a very small percentage of bank loan portfolio was providing capital to the agribusiness sector. And then in partnership with the German Development Bank, decided to anchor a private equity fund. And we're a fund manager of that some of that capital, some may be biased, but I think trying to think how to bring new money in a non-traditional way and partner with different sovereigns to do that, I think was pretty creative. And I think what is happening now is other countries are looking to something comparable as they raise capital. Now, this capital is less than 30% of the money we manage, the rest is international. But I think that's is a positive. In terms of the international investors, the social impact of what kind of return they expect, I think it's a mix. So we have one bucket where it is effectively commercial return expectations, but they do want impact. So there's an investment decision that is made. Does this make financial commercial sense? Yes. Is there impact? Yes, we move forward. There's a different pool of capital we have that is impact first. Is there impact? Yes, then they're willing to set a lower return. So as we fundraise, is effectively what is the investment strategy? What are we trying to achieve? And who is the appropriate investor group to then partner with to achieve that? And there are different reasons for that. So there is, now I'm a big believer that if you should not subsidize investments in some form, which I think when people think impact, then they think there's some subsidy of the return you would expect. But it's saying, can you have impact and also commercial returns? And I'll use the poultry company as probably a good example, is of how you can combine both. So we work with a ton of small farmers today that counts for a huge amount of volume coming in. It's livelihoods, it's route to market. At the same time, it's less capex for expansion, less biosecurity risk. It also makes commercial sense. So I think for us, being attentive to this is very critical for us. But different pools of capital. You had other questions.
That's okay. I think you touched on it. I mean, but these different pools of capital can be mixed in a particular venture, or you try to keep them separate?
It can be mixed, but I think we've learned from experience that it's best to keep it separate, because you engage with investors and you want to make sure you have that here's the return, we'll focus on the return. And if you mix in impact into that, then it gets tricky. Now, what we have seen, though, is that where you have the DFIs anchor quite a few of the funds, a lot of international pension funds get concerned and do not want to invest because they feel that impact may be picked over return. So there's always that trade-off for funds.
Since the time is almost up, can I ask a question of my own?
Sure.
What do you say, would you like to say to people who say, this is too difficult, these countries are impossible to operate in, it's like banging your head against the wall, you can't really have impact, the system will overpower you. You bet your life on this and you put your time into risking that. Who do you say?
It is true stuff. I've gotten quite a few gray hairs being involved. It's not easy to do, but there is a huge amount of impact. And the way I think about it is, and I speak with somebody who spent a lot of time in the oil and gas sector, is can you do good for yourself professionally and financially and still have an impact? And to the degree you can do that, then this journey just makes a lot of sense. But is it tough? Is it easy? It's very tough. It's not easy. There are easier ways to have a successful career. But I think it really comes down to what impact you want to have and still do well for yourself.
Okay, last.
So in your slide on why invest in Africa, you said that it was one of the things you mentioned was the opportunity to build disruptive technologies to bypass existing infrastructure. And that's certainly the impression that we've had interacting with healthcare workers in Ghana. But I was wondering if you could elaborate a little bit and maybe even provide an example of how that has worked in Africa, because I think there's huge opportunity there, but I'm really interested in your experience.
There is, and I'm trying to think of a good example. So there are healthcare platforms. There's a company called, and I'm on the P side, not DC. So I'm also thinking about, so the company called 54 Gene, if I'm remembering the name correctly, and I can confirm that name for you. So even gathering DNA data, most of it is Western US based, not Africa based. And I think a lot of work they're doing is gathering a lot of that data to then be used for research and analysis, and have done a ton of work, raised a bunch of money, have been successful. I think that will have long-term implications. There are a range of mobile payment systems, mobile banking, a range of have an impact. On the distribution side, Trade Depot is doing something similar in terms of changing the way distribution of products is happening. In Kenya, there is, and I'm blanking on the company's name, a firm that is effectively taking agricultural products from rural areas farm to deliver directly to formal retail, which is hard to do. Now, the difference, if I was to say one thing that makes it tough, is that even though they're still pitching technology and asset light, they still have to build a lot of their own fixed asset distribution, or they're not going to distribution of other assets, which is still heavy. But there's quite a bit. But I can speak offline about and give you names of a number of different firms on distribution side, ag side, healthcare side.
Thank you.
Yeah. Thanks.
And the 4 examples include some which are social and some which are not social. They're all commercial. So they're all commercial. Yeah, I mean, this is a mix. We're doing this for financial return, but it has huge impact. This is, I didn't mention, is a large-scale commercial farm, but they also source from 3,000 farmers, rice paddy from 3,000 farmers into the system. This is probably more commercial, less social. But it depends how you look at waste management. So to the degree of you handling waste recycling, then there's impact there. From a climate perspective, they went from a 1 megawatt diesel generator to a gas-powered plant, and separate from just more efficient, even the noise decibel level, noise pollution gone down. And this is purely commercial. Really, I would have thought this was social. So the interesting thing about this is, there's the impact that businesses will have transforming, working with, in this case, many small retailers in informal markets. But I guess I'm thinking commercial because of the mindset of the investors. It's VC investors, it's us, it's international, domestic, and everybody's looking for the next unicorn. So, and yes, there's impact with SMEs and retailers, but the push is really along how do you scale this platform across the continent. But I think given the informal nature of the sector, informal sector is huge. You have many small farmers. Anything that engages in the informal sector or small farmers, we can have impact in some form. I would have thought this is a long game. Well, it depends how you define long, and 10 years. Before you can actually get it up and scale it up and connect and make it economic, because I think it's very expensive to reach the informal network. It's yes, and so for us, so we invested in a Series B,
we're planning to exit in a Series D. And there'll be other investors that might stay longer. And but even the rice opportunity, if you think of large-scale commercial farming in the West, people do it for generations, and they know the soil, they know the seed they use. And this company has been 4 years, 6 years, 4 years. So it's this would take a little bit longer to actually get commercial value out. Okay.
Keep going, but I think
I'm happy to take questions afterwards, even if they're questions. So that's fine.
thank you.
Thank you very much.